Inheriting a home can bring a mix of emotions, from comfort and cherished memories to a new set of responsibilities and financial questions. Navigating existing debts, especially a mortgage, can feel overwhelming during such a time, but understanding your options can provide much-needed clarity. You might be wondering if you can just step into the shoes of the previous owner and keep the mortgage as is. The direct answer is often yes. You can assume the existing mortgage on an inherited house. This is thanks to a key federal law called the Garn-St. Depository Institutions Act of 1982. This act provides important protections for individuals who inherit property, preventing lenders from automatically calling the loan due just because ownership has transferred. The Garn-St. Act specifically restricts lenders from enforcing due-on-sale clauses when property is transferred through inheritance. A due-on-sale clause typically allows a lender to demand full repayment of the loan if the property is sold or transferred. However, this act carves out crucial exceptions for transfers to a relative after the death of the borrower. This means that if you are a relative who inherits the home, the lender generally cannot force you to pay off the entire mortgage balance immediately or refinance into a new loan, simply because ownership has changed. Lenders often prefer to keep a performing loan rather than going through foreclosure, so allowing an heir to continue payments can be a sensible solution for them too. To assume an inherited mortgage, your first step should be to promptly contact the mortgage servicer or lender to inform them of the homeowner's passing and your intent to discuss the mortgage. You will likely need to provide documentation such as a death certificate, the will or trust documents, and the property deed or probate records showing your legal inheritance. Carefully review the existing mortgage terms to understand the interest rate, remaining balance, and monthly payments. Assess your financial ability to make these payments consistently. It is important to discuss all your options with the lender, which could include formally assuming the loan, refinancing, or selling the property. Considering legal and financial advice during this process can help ensure you make the best decision for your specific situation. A due-on-sale clause is a standard provision in most mortgage contracts that protects lenders. But the Garn-St. Act acts as a powerful shield for heirs, offering an exception that can save you significant time and money. While you are not personally responsible for the inherited mortgage debt until you formally assume it, the house itself remains collateral for the loan. Formally assuming the mortgage means you take on the legal obligation to make payments. This can be particularly beneficial if the existing mortgage has a favorable interest rate that is lower than current market rates, allowing you to avoid the costs and complexities of obtaining a brand new loan. It is a way to potentially keep a valuable asset with manageable payments. In conclusion, while inheriting a house with a mortgage presents a unique challenge, the ability to assume the existing mortgage is often a valuable and beneficial option for heirs. By understanding your rights under the Garn-St. Act, communicating proactively with the lender, and carefully evaluating your financial capacity, you can confidently navigate this process. This empowers you to make an informed decision that honors the legacy of the home and aligns with your financial well-being, turning a potential hurdle into a clear path forward.